All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Our guest today is Ben Carlson. Ben is a chartered financial analyst and the director of institutional asset management at Ritholtz Wealth Management. Ben also has a blog, A Wealth of Common Sense, where he writes about wealth management, investing, financial markets, and investor behavior. He's the co-host of the popular Animal Spirits podcast. I'm a huge fan of that. And he's also the author of several books, including his most recent book, which I'm here to talk to Ben about, Risk and Reward. I got my copy here. Ben, thanks so much for joining us.
Thanks for having me.
Awesome. Yes, let's jump into the book. I read it. I love it. When I was in my mid 20s, I read The Four Pillars of Investing by William Bernstein. It really opened my eyes to a lot of things. And reading your book, I got the same kind of feeling. I think it's great whether you're a new investor, but it's kind of evergreen. There's like timeless classic lessons in there for somebody to circle back to. Like, it was refreshing for myself. I consider myself very familiar with a lot of this stuff, but the way you outlined it, there's a lot of data, a lot of graphs, a lot of reasons why, and I just love everything about it. So you want to tell us what inspired you to write Risk and Reward there?
Cool. I love that you mentioned the four pillars. That's one of my favorite books. Bernstein is one of my like heroes in the investment thought leadership area because I think he hits on the most important stuff. And he always says that like the four most important things to understand are you have to understand some math if you're going to be a good investor, right? You really have to understand financial market history, and he did a good job of explaining that in his books, I think. Um, you also have to have kind of an interest in the process, right? If you're not interested in something, it's going to be hard to stick with it. And then the other piece is the biggest one is behavior. And so I think having all those things, that's what I tried to really hone in on here. And you're right, a lot of it is probably stuff that we're reinforcing in terms of understanding markets and how they work. And I think I wanted to write this book for really two different types of people. One of them was the people I was dealing with coming out of the 2008 financial crisis who were in the fetal position and just thought like, oh my gosh, the stock market is way too risky for me. I can't take part in it. I need to just take a step back. And the other people are maybe they weren't around for the 2008 financial crisis and they don't know how bad things are because they're only invested this decade and they're going, oh my gosh, this isn't that bad. Sure, we have a few pullbacks here and there, but they don't last very long. And if I buy, it comes right back. And so I wanted to kind of remind people risk and reward is like the yin and the yang of like you don't get one without the other. So I think it's important to remember both sides of the coin there, that you can never get too conservative with this stuff, but also you have to remember that like the reason that stocks produce such good returns is because there are really nasty, bad, scary, painful things that can happen.
Yeah, totally. And I think, there's a large cohort of society out there that's familiar with, okay, long-term passive investing, just, it'll work out in the long run. But I love that your books kind of took it a step further beyond just that tagline or the headline. It says, here, look, I'll show you exactly why in the worst and the best cases. So I love that, it took that extra step to explain here to to remove the shadow of the doubt and the just the headline. Let's go in and show you.
Yeah, I think that was the main point is not just like I don't like the idea of like buying and hoping, like hoping things don't go wrong, right?
Mm,
Like, what if my investment time horizon just perfectly lines up with like this perfect period and I don't have to worry about like you have to have a backup plan and perform like a pre-mortem of like what do I do if and when things do go wrong. It's funny, we get a lot of clients who reach out to our firm during bear markets because they realized that there was no plan B from their financial advisor, right? Or they themselves didn't know like what do I do when this situation happens? And I think you have to provide context around that stuff to understand here's how you can survive this stuff and here's a perspective you need to understand what you need to do. And you can't try to come up with something on the fly. You have to have a plan in advance.
yeah, completely. One of my favorite Bruce Lee philosophies that I live by within my relationships and my business and my whatever it is, everything is this idea of as complex as necessary, but as simple as possible. And I think that applies too to a lot of the lessons that you're kind of conveying in this book, as far as there's no one perfect investment strategy, but there's a lot of them that'll work, and complexity isn't better, right? Being active, being always engaged, as complex as necessary. We don't want to be too simple in our approach to everything, and you want to be aware of things, but as simple as possible. I love that. I just love that philosophy. What are your thoughts on that?
Yeah, I'm on board. I never heard that from Bruce Lee before. I'm gonna have to remember that one. My whole thinking is just like less is more, and I do believe that simple beats complex. But you're right. Part of the investment process, it does have to, it's never easy,
Mm,
right? There's always some problem. And I totally agree with you. I think there are some people who assume that like investing is a solved problem, right? We've figured it out, we've solved the problem. And I've met with and dealt with it, thousands of investors over the years. And I know that there's not one right path that works for everyone. There are people who get rich by investing in individual stocks. There's people who get rich by starting their own business or investing in real estate or technical analysis or right fundamental driven stock picking using factors, whatever it is, index funds. I've seen all different types of people who are able to build wealth. And I think some of the things that they all share in common is having a process that they can stick with, right?
mhm.
And I think if it is too complicated to the point where you don't understand it, it's a lot harder to stick with. It's way easier to hit the eject button if there's something that you don't understand and you don't believe in. If you don't know what you own and why you own it, I think it's really hard to stick with it when it's not working because nothing works all the time. There's always something in your portfolio or in your strategy that's going to have a hard time and not work. So I think that's the part of where simplification helps a lot is just like, okay, fine. It's not working now, but I understand why it's not working. And I expected this to happen at some point. So it allows me to lean into the pain and stick with it or maybe buy more when it's down.
Yeah, and the other thing that came to mind, and you talk to a lot of sophisticated people on Wall Street, a lot of at least with your firm and the podcast and all, and I would say a lot of high level, really smart investors. And I think for the average person out there, there's still this belief that with the market, it's this black box. And Ben, you must know a secret that all of us don't. You guys know a secret. You guys are making a lot of money because of the secrets, and I don't know the secrets. Is that
Yeah,
right?
yeah. I think a lot of wealthy people assume that, like, okay, fine, but wink, wink, hint, hint. What do you like? There is no holy grail, but what do you got for me? Like, what's the secret back door that you can open for me and show me how to do this? And I think the other thing is, a lot of people, if they're successful in one avenue of life, a lot of like doctors and lawyers and engineers, like they did a lot of schooling, right? Very intelligent people. There's this assumption that that intelligence is going to automatically translate into the markets. And the problem is a lot of them have been taught, rightfully so, that like the harder you work, the better you get at something. And with the market, sometimes it's the opposite. Like the more you do, the worse your results tend to be because there is no like degree of difficulty in the markets,
Mm,
right? So I think sometimes there's that misnomer. And yeah, and so sometimes you can be so intelligent and so smart that you're overconfident in your abilities and you think you're smarter than the market
right.
overall. And I think that's where people get into trouble is thinking like, oh, everyone else is an idiot. No one, I'm the only one who really understands what's going on, not them. They don't realize the market's wrong about this. And the market's obviously not always right, but it's right more often than you think.
Yeah, completely. So that brings me to my next point is when does investing turn into gambling? So I think the platforms like Robinhood and there's several others, they've done a lot of great things, and I think we'll get into this later. And your book touched on it. There's more people who are involved in the market today than ever before, and that's a great thing. Um, but the allure of I think I got the quote later. I'll say I forget what it is, but the idea that we have to do something, we want to feel control, so we do something, and then we get into this day trading. We get into options and futures, right? And a lot of us walking through our lives, we might come across somebody. I know I do, where they're going to tell us, "Oh, I made this X amount of dollars on this, this options trades or this futures," and in my opinion, it's mostly there to give you a sense of to lift them up and to give you a sense of FOMO there. And with some of these people, and I'm not trying to put anybody down, and I don't think there's anything wrong with speculating and what I would call gambling, but just don't call it investing because what you're doing, there's like those are two different things. And I think if you're going to call it investing and you're doing a lot of the active trading, then you should have some background or at least some method of financial analysis of how you're going about it. Otherwise, it's just purely speculation and gambling.
Yeah, there's definitely a process element that turns you from a speculator into an investor. I think the hard part about investing, especially this decade, is you're right. There's so many people that have gotten overnight riches, and it's so much survivorship bias that you don't see. You see one or two examples of it, but you don't see the hundreds of thousands of people that tried to and didn't have it happen, right? They didn't
Mhm.
hit it out of the park with the stock pick or the options or the crypto or whatever. And I do think that to be a good investor, however you invest, it requires a thoughtful process that you can follow on a consistent basis. It's like, rules and guidelines that you can follow. If A happens, I'm going to do B. If X happens, then I'm going to do Y. And I think that's the biggest difference between speculation because anyone can get lucky, right? But winning a lotto ticket investment is not something you can consistently do, right? And
Right.
sometimes the worst thing that can happen to you as a young investor is you do knock it out of the park and you time the market correctly, or you pick the great stock that goes up and you go, oh, this is actually kind of easy. I can do this again and again. And we all know that that's impossible. No one can do this stuff consistently.
Yeah, the overconfidence, and I think I don't know. We may you would know better than I do. We may be facing some of that overconfidence because of this secular bull market run that we've had. That I think people are feeling themselves. They're feeling pretty good out there. It's very. I don't want to say it like this, but it is kind of easy to make money in investing in this time frame, right? From 2008 on.
Yeah, yeah. I wrote something recently that about how just because there's a bull market doesn't mean you're a smarter or better investor. But just like when there's a bear market, you're not an idiot. You're not a
Yeah,
worse
right.
investor. Sometimes it's just about the timing. And I do think there is something to be said about having a little humility and being grounded and understanding that, yeah, I'm kind of just riding the wave here. And
Right.
sure, you can make better selections than others at times, but yes, this has been a great time to invest. It's kind of crazy to think about the fact that the U.S. stock market was up 13% per year, or something in the 2010s, coming out of the Great Financial Crisis. Really, really, above average returns,
Mhm.
and returns are higher on average this decade already, like 15% per year. So we've lived through a really relatively calm period in the markets. There's been stuff that's happened, but no financial crises, no real big recession, to speak of. Yeah, so this hasn't been the most challenging period to be an investor. It's been a great time to be an investor.
Sure. Can you give us an overview of why the time horizon, a long time horizon, is the most advantageous thing for an investor and how, I don't know, if you just touch on it broadly, just, if you have a long time horizon, you're going to do okay in the end.
I just think having the correct time horizon in mind when you're investing in any type of investment is one of the most major decisions you can make, right? Like, am I spending this money in 3 to 5 years on a house down payment or a wedding or something, or my kid's college fund? Or am I going to save it for retirement and I don't have to touch it for decades? Because people always like to link the stock market to a casino, right? It's a casino and it's rigged against me or something. But I always say that the stock market is the best casino in the world because the longer you sit in an actual casino at the tables, the higher your odds of walking out a loser because the house has the edge, right? It's a
Right.
mathematical. The longer you stay in play, the higher your odds of losing. And the stock market is different. The longer you stay in the stock market, the higher your odds of potential of seeing a gain. So I give the stats in the book that like on a daily basis, it's 50, call it 53, 54% of all days, trading days are positive,
Mhm.
meaning like 46, 47% are negative. And that's just a little better than a coin flip on a daily basis. But you go out 1 year, and now we're talking about 75 to 80% of the time it's positive. Go out 10 years, and now we're talking it's, like 96, 97% of the time is positive. And I think that the US stock market has never been down over 20 years. So that's the thing is you put the odds more in your favor when you have a longer time horizon.
Sure. And who I work with and this podcast, a lot of the topics revolve around retirement planning. And when you look at retirement planning, I often come across this. I always often say, we're not investing to retirement, we're investing through retirement. Your retirement might be 20, 30 years, hopefully, right? And so a lot of these principles still hold true. Now, it's a little different because we're talking about distributions and the timing of distributions, the timing of rebalancing, and having some diversification to kind of ballast the portfolio for making it a distribution portfolio kind of changes things. But the principles remain the same because you still have that long time horizon. And like you said, if you know you're going to retire and you need to pull X amount of dollars in a couple of years for, the first few years of retirement, you're obviously going to position that money in a way where hopefully it'll be there, or you position the portfolio in a way where you're going to have that ballast to hopefully if the market, takes a dip, you're not going to feel it as bad and you can continue on, right? Because what I
Hey,
don't like, what I don't like is I don't want people to delay their spending in retirement because of what the market did. We want to position it so that way you spent your whole life working, let's enjoy it, right? And you got to position it that way.
Yeah, amen. The baby boomer generation is going to live longer than anyone that came before them. I think the numbers are like a 65-year-old couple today has a 50% chance of at least one of the spouses living until their 90s, right? So we're talking 20, 30 plus years potentially to continue to grow that money. Now you're right, you have to balance it a little bit out with the fact that they're spending in the near future, but you have to keep up your standard of living, right? A 3% inflation rate could cut the value of a dollar in half in like 22 years or something, right? So you still have to grow that money and take some risks. And we tell that to clients all the time too, that like you can't just shut it off and say that you've won the game. You have to continue to invest and grow the pile to spend it. But I'm totally on board with you in terms of, yeah, spending the money and enjoying it as well. So there has to be some balance there, and you have to have some sort of margin of safety built in.
Yeah, and I heard it framed, and it might have been on your show, one of the compound shows, or somewhere else, but somebody framed it as cash has a negative 3% yield. And when you frame it that way, you start to think about, the real risk isn't isn't the market risk. The real risk is inflation risk.
Yep.
More so than anything else, right? Purchasing power uh can be the real risk in somebody's retirement portfolio or any portfolio.
Yeah, you got to keep your standard of living up. I write about inflation a lot in the book because it seems like we've got a reminder of it this decade. Like, oh my gosh, we thought that we just ironed it out of the system and we didn't have to worry about inflation anymore. It's only going to be 2%, and that people can deal with that. And you see the volatility we've had in prices this decade. It can change things on a very quick basis. You have to have some assets in your retirement portfolio that can account for that.
Totally. Market timing and rebalancing. Rebalancing your portfolio. If you have a system in place, maybe that's semi-annually, quarterly, annually, it acts as a way of kind of in some ways dollar cost averaging, and you balance out the market timing. But I think you mentioned in the book there, market timing requires you being right twice. If you're going to pull your money out, okay, hopefully I was at the high. And when am I getting in? Hopefully I'm at the low. And the odds of doing that, even for a sophisticated, high level investor, is really, really difficult, right?
Well, the biggest challenge there is the psychology behind it, right? So it's easy to you talked about like having action, and there's this old like Roman army saying that like action removes fear. So doing something like hitting the sell button, hitting eject during a downturn or some volatility, it feels good because like, oh, I did something. I put my hands in the steering wheel. I took control. But then you got to think, well, now when do I get back in? So this is being right twice side of it. I'll just buy back in when the market is down 20% from here, right? It'll be fine. I'll wait for the dust to clear, then I'll buy. The problem is, if the market actually does fall 20%, then you're not going to want to buy then either because you're going to go, well, wait a minute, this is pretty scary. What if the market falls another 20% from here? And then you get this cash becomes an addiction to this market timing where you just keep trying to time it perfectly. And the other side of it is, what if you sell and then the market takes off and it goes up 20 or 30%? Do you wait for it to fall back to where you were, or do you put in and then you kind of are chasing? And that's the hard part, is that if you don't have some rules in place to guide your actions through this stuff, it's just really challenging. And I talked to so many investors that came to us in 2014, 2015 that said, I sold in 2008 financial crisis. I saved myself from some losses, but then I never put the money back to work. I'm still sitting on cash 6 years later because the bull market took off and I was waiting for it to pull back, and it never did, to the point where I wanted to get back in. And it's just like debilitating for people.
Yeah. And a selfish plug for the financial advising industry, having that person who's a third party who's not, because it's easy for us to sit here and say, oh, well, if the market drops, just don't do anything. Yeah, say that to somebody who just lost, 500 to $1 million or whatever it might be. It's very emotional. It's hard, right? And having that third party objective person on your team, that can go a long way.
Well, I always say that the biggest question that everyone wants to answer when they come to a financial advisor, regardless of how much money they have, is just, am I going to be okay? If I do put this plan in place, am I going to be okay? Is my family going to be okay? If I decide to buy this vacation home with my retirement dollars, am I going to be okay? Does it change my plan at all? Right? And having that, you're right, that objective third party to tell you, like, listen, we built in the fact that markets are going to fall into this plan. Like, there's going to be bear markets. It's part of the plan. We built you a durable enough portfolio. You're right. It can be helpful to hear from someone else who just goes, you know what? take a deep breath. You're going to be okay. And I agree that the whole idea, like financial advisors love to say the phrase, like just ignore the noise, right? Which
Hmm.
sounds great, but you can't ignore all the noise today. It's a fire hose, right?
Mm,
And it's spraying you every day. So you have to figure out ways of not just ignoring the noise of, but filtering it correctly and having guidelines in place and listening to the right people and the right sources. And everyone has phones in their pockets now. Like you can't the alerts are on that you can't ignore the noise. It's constant. And so you have
right.
to figure out ways of dealing with the noise. And that for a lot of people, that's like placing limitations and guidelines on your portfolio about the stuff you will invest in and won't invest in and when you'll make changes and when you won't and all these things. And the funny thing is, as well as I do, the changes to portfolios typically come from life events, not necessarily the market, right?
Mm,
It's
right.
markets can change and the risk reward framework can change based on level of yields or level of stocks and the valuations and all these things. But most of the time, it's did you have a life event that made you change your risk profile and your time horizon, those types of things.
Sure. Quote from the book that I love: financial panics and stock market crashes are a feature, not a bug, and they're never going away. So true. And the next one is coming, and we don't know when. The problem is when when you know that it's a feature and not a bug, and you accept this, uh, you can spend a lot of your time looking over your shoulder, which isn't a good feeling, right? So it's hard to accept that and just like it's just everything we were just talking about to just keep moving
Yeah,
forward, knowing that that's coming.
I felt this coming out of the great financial crisis. The fact that like I felt like people were spending 90% of their time planning for things that happen 5% of the time, right? Like these things, these huge crashes, most 10% corrections don't turn into a 50% crash, right? They're pretty rare, but that doesn't mean they can't happen, right? I think you have to
Right.
plan in your investing lifetime on, I don't know, perhaps two or three times the market's going to fall 40 or 50%. And you just don't know when it's like, if you think about it, we didn't have that happen for a very long time, and then within a 10-year period, and the dot-com bubble and then the great financial crisis, it happened in the span of 8 years,
Hmm.
right? So you can't like set your watch to these things, but you have to
Right.
understand that like because of human nature, we tend to take things too far in both directions. And that's why there's all these overreactions and underreactions, and it's kind of part of the markets these days.
Sure. And can you speak to talking about the noise, right, in our phones and the news headlines? Can you talk about why the economy and the market sometimes rhyme, but they're not one and the same, right? We can't read a headline on the economy and expect it to impact the market, and we shouldn't let that influence our behavior as it pertains to the market in most cases.
Yeah, if you think about it, I mean, the economy is this big 30 plus $1 trillion behemoth, and it's kind of like to get it to move, it's kind of like turning a battleship, right? It takes a while. The economy is slow, this kind of slow and plodding, and things happen way faster in the stock market, especially today with information age and the way that things are. And I don't know, something like 50% of the stock market is now tied to technology in some way, right? And that's not the economy. The economy is more, service-based businesses and um, so yes, the long-term trajectory of the economy going up and the pie growing, that's good for the stock market because you kind of need economic growth for stock market profits and revenues and these types of things. But the old saying that the stock market has predicted 9 of the last 5 recessions is true. Like the stock market is just so much more volatile because there's expectations built into it, extrapolations, and individual companies, which themselves don't impact the overall economy, right?
Right.
And so you have to kind of separate the idea that the anecdotes you hear about the economy are going to impact the stock market and vice versa at all times. And it's not always like that. We had a pretty nasty recession in 2022, and people were sure that there was going to be a recession, and it never happened, even though the stock market went into a bear market. And so I think the problem a lot of people have is that they think about their own personal economy as
Mm.
being like part of like the greater whole. When your personal situation is nothing like those overall aggregates. No one has the overall aggregate as no one has the inflation rate.
Right.
Your
Right.
personal
Right.
inflation rate does not match what the
Sure.
government is saying, right? Because it's an average. It's all of us. It's collective, and you have your own personal stuff, and that's why some of this stuff is totally out of your control, right? When the stock market is going up a lot, when it's going down, what's happening in the economy. You can only control what's going on in your universe, but you can't assume that your universe is what's happening in the rest of the world.
Yeah. But it's so enjoyable for a lot of us to read and invest ourselves in these what's happening in the economy, what's happening here, and we want to know. And a lot of it is just does it like you said, does it really impact your life? Some of these things, and like not really, but we love kind of
I
being on
do.
that front. Yeah,
I
yeah,
love paying attention to it too. It's fascinating to me.
right,
Um, but it's so hard because the economic data is sort of reported on a lag, and then sometimes it can be changed and updated and revised. And the headlines don't always tell you. If you looked at just the economic headlines, if you remember back in April of 2020, the stock market had already bottomed and it started taking off again. The economic headlines and the headlines in the world at large were as bad as they could have possibly been. And the
right,
stock market was taking off. The unemployment rate was rising. The stock market was taking off. So if you would have taken your cues just from those economic headlines and economic data, you would have been completely wrong, right? This is the idea of I'll just wait for the dust to settle and then I'll invest my money. But the stock market doesn't wait for the dust to settle. It moves way before then. And
right.
sometimes it moves to the downside before like it's even in the headlines, right? And so you can't if it's in the headlines, it's probably already been priced into the stock market and the market has moved on.
Yeah. And what I love is the stock market, it's like the ocean and waves rolling in. It doesn't care if the sun's out, if it's dark, if the wind, like it's its own beast, right? The economic stuff can be politicized, there can be spin and influence. The market is kind of in some way its own pure entity. I don't know.
Yeah, I always say that the market is heartless. It's like you're
Yeah,
right. It's apolitical. It's amoral. It doesn't. It all it cares about is like profits and growth. And
right.
if the trend is good, the stock market doesn't. Because it's weird. Because a lot of people, I think, when the war in the Middle East happened, in the stock market, people were kind of wondering like, why isn't the stock market falling more? Right? And people almost took it personally. Like this, it should be falling
Right.
because this geopolitical stuff is going on in these headlines and it feels bad that we're at war and the stock market really doesn't care because all it cares about is the profit numbers.
Yeah. Okay, let's talk about diversification. So in your book, I love this quote. Diversification is about giving up the ability to hit a home run so you don't strike out at the plate. And factoring in things like you mentioned in the book, loss aversion and stuff like that. I mean, diversification just makes so much sense. But in the same breath, it's hard to convey the importance of diversification when you see like the Mag 7 and you see it and you're looking in a small time frame and you're like, well, why would I invest in international fund? Why would I invest in whatever it is, small cap and all this? When you see such a great run in a certain sector or a certain company.
You're right. The past, call it 10 to 12 years, has been really hard to be a diversified investor because there's, I say this saying in the book, I stole it from Brian Portnoy. Being diversified means always saying sorry about something.
Hmm,
But I'm sure you had clients too who were like this, who said, "Why would I ever invest in anything else besides the S&P?" And it's funny because after the 2008 crisis, it was the opposite. People were going, "Why I should be invested in all these other things?" Because the S&P was terrible and dead money for a decade. And it's funny how these things come around. And now we're seeing it again the last couple of years where, international stocks have finally done a little better, and emerging markets and
right.
small cap and value and all these other components of the market are finally coming back. But it was a long time where people go, well, geez, this diversification isn't helping me. It's just hurting my returns. And that's the hard part with it is it doesn't necessarily protect you against like bad days or months or even years in the markets. The whole
Right.
thing, it's like it's just potentially a really bad cycle for a certain aspect or an asset class, and that's what you're trying to protect against. And so, yeah, being diversified is not necessarily easier as an investor, but it's a risk management technique. I always say too that if you cast a wide enough net, you can also have some unexpected winners take place in your
Yeah.
portfolio too that you don't necessarily know those winners are going to come from in advance.
Sure. Yeah, and I love that in the book. For those, pick up the book and read it, and you kind of point out in certain time periods of when you can see when international investing really paid off. You can see when real estate really paid off. You can see all these different time periods and put it all together. Let's talk about bonds because bonds for the longest time were, and they still are. They're I would say the go-to ballast to equities in somebody's portfolio. Obviously, you have, stuff like REITs and treasuries and all these other stuff, but bonds um kind of always played an important role. Now, 2022 happened. In 2022, the bond market had a painful bear market and they both dropped. And there's a lot of people saying, well, See, I mean, there goes your that was supposed to be your diversification and your ballast to your ship there. What happened? What are your thoughts on bonds and do you think they still hold up as in their role?
It's interesting because in the call it 95 or 100 years before 2022, there's only like three or four times that stocks and bonds had ever fallen in the same year at the same time. And the times that bonds fell, it was like 2 or 3%. It wasn't a huge fall. So that was by far the worst bond bear market in history. Now you could say that's probably a one-off because rates were taken down to almost zero, and then they had to be jacked back up to 5% again because of the inflation and the spending. And it was a weird thing with COVID, right? COVID happened, government takes rates really low, inflation happens, they have to take rates very high, and that really screwed with the bond market. I think what it did wake up a lot of people to the fact that like maybe my diversification, getting back to our diversified talk, I need to be more diversified in fixed income, right? And I need to plan for other economic environments. And for 40 years or whatever, interest rates just kind of slowly and methodically fell. And I think people got lulled into this full sense of security of, oh, this disinflationary environment, that's just what it's always going to be. And if I just invest in any kind of, treasuries or high quality government bonds or whatever it is, or corporates, I'll be fine because rates fall and I'll be good. But rates fell to the point where they couldn't fall anymore. And
Right.
so I think people have realized, like, well, maybe I need to add some protection against the possibility of rising rates or higher inflation. And there are ways you can protect against that fixed income, but you just might have to be a little bit more diversified. And I think it was kind of a one decision asset class for so many years and decades that people now have to just be a little more thoughtful about it.
Yeah, completely agree. Let's talk about real estate for a little bit. I'm going to do a couple episodes coming up on real estate, kind of on the tax side of selling real estate. Um, but real estate, what I love in your book, in the 1970s, housing prices rose nearly 130%, which is almost 9% a year. We just recently saw, I don't know what the numbers are, but a great run for the housing market, right? Prices shot up, and now we're seeing that stagnation. Um, yeah, I think there was a lot of people like the bigger pockets generation with the real estate investors and rental properties. That's kind of a relatively recent phenomenon. Not that that hasn't gone on in the past, but the people who are out there flipping and buying and renting these properties, um, I have no problem with it. I think it's a great thing. But I think the point that your book gets across is just be aware that there might be times when this may not look like a good decision, right? Or as good of a decision in the real estate market. And that's okay. Just know that there's going to be ebbs and flows.
Yeah, we obviously pulled forward a lot of years of housing price returns in the first 3 years of this decade or whatever, right? Housing prices were up 50% or something in 2 to 3 years. Uh, and yeah, you're right. It happened in the 70s too, where you had this huge boom in prices. And we're seeing a lot of people who say, hey, listen, I'm moving houses, but I got a 3% mortgage on my old house. I'm going to just turn that into a rental property. And when I buy my new place, I'll build equity. Um, and I think it's the kind of asset class as an investor you have to go in your eyes wide open. It's not something that you can just do on the side, right? You
Mm,
you being a landlord requires it's a lot of work,
sure.
right? And you can outsource it, but you have to understand what you're getting yourself into. If you're going to call at 2 a.m. saying, "Hey, the toilet's broken," or "There's flooding," or "The air conditioner doesn't work," something like that, it's definitely a much more hands-on type of investing. And you're right, it can be lucrative and it can work if you know what you're doing. But there are also times, just like the stock market, where prices can stagnate. And you're right, on an inflation-adjusted basis, housing prices in the U.S. haven't gone anywhere for a few years.
Hmm. Yeah. Yeah, and it's easy to fall prey to the recency bias when things are shooting up and you're looking around at the houses you want to, in your neighborhood and you're like, wow, it's really, and it's easy to get sucked into that and think that trees are going to grow to the sky, but usually they don't. Um, so let's end it here with this kind of the growth of stock ownership and what the future looks like for markets. With a lot of this stuff, it's kind of crazy to think because I'm we're probably close in age and our economic system and the markets we live in we've kind of grew up in. But if you look out and your book points this out, like in 1953, only 4% of the country owned stocks. That's not that long ago. That's,
Right.
I mean, in the grand scheme of things. So, okay, let's say that's 70, what is that? 70, let's say 75 years ago, right? So in 75 years from now, yes, things could look completely different. Well, but we don't know. But I just think it's interesting where we use all we have is historical data to use, right? We can't just sit here and make, projections and live in a world of what ifs. We have to look at historical data, but I think you can look at it with a caveat and say, well, I can learn some lessons from that, but those were really different times. Like even you're talking in the 80s. I mean, it is a little bit of a different world. Not that those lessons don't hold true and shouldn't sink in.
Yeah, the studying market history does not allow you to predict the future any better. I think it helps you understand a range of outcomes, but you're right. Things like the 401k and the IRA totally changed how people invest. And then we have $0 commissions now, right? And there's no minimums anymore. I told someone the story recently. When I graduated college in 2005, I wanted to invest in a Vanguard index fund, right? Low cost. I read the Bogle books. Hey, I'll put in. And they said, okay, the $3,000 minimum. And I said, well, I just graduated college. I don't have $3,000, right? Now
Right.
there are no minimums. The barriers to entry have been completely knocked down. So it's easier than ever for people to invest. And the stock market is just now more important than it ever was in the past. And you're right. I don't know how much more that evolves. Do we get more households involved? Even this decade alone, the bottom 50% has seen the biggest increase in stock market ownership of any group, which is
Right.
really cool to see. But it's just, you're right, the stock market is so much more important. So does like the wealth effect have this like slingshot where if we have a recession, the stock market has more of a prolonged bear market? How much is it way more important to the economy now? And all these things, you're right that these environments are never quite the same. And that there's this the old quote like people who don't study the past are doomed to repeat history or whatever.
Mhm.
But I think people who study history too closely assume that it's going to replay itself exactly, and it doesn't really. If you look at that, the past of markets, like the next risk is rarely like the last risk,
Right.
right? It doesn't always work out as neatly as you think in an analogy.
Sure. Yeah, and and it's hard living in a world of unknowns, but that's life, right? We don't know what the future holds. Maybe AI will take over the world and everybody's screaming to invest in ammunition and gold. Maybe they'll be proven right. Unlikely, but maybe, right? The thing is, all these like situations, you can't just so let's say somebody came at a young engineer and said, well, what are you doing? AI is going to take over. Yeah, maybe you might be right, but what are we going to do? Are we just going to throw our hands up and say, "Well, okay, I'll just sit on my couch and that's like we have to keep proceeding in the markets, and in life, in career progression. We can't live in a perpetual world of what ifs because it's indefinite. Well, what if this? Well, what if this? Right? What are your
Yeah,
thoughts on that?
if you want to guarantee you have a terrible retirement, don't invest any of your money, right? Keep it in a checking account, bury in the backyard. And if you want to give yourself the possibility of improving your standard of living, you invest it. You're right. It is a risk. You're sort of jumping out of the airplane with no parachute in some ways. We don't know what the future holds. I certainly don't. It's kind of funny. I don't think anyone would have possibly predicted a 15 plus year bear market or bull market coming out of the great financial crisis. No one was predicting that. People were saying the returns are going to be lower than ever, growth is going to be low. Coming out of the 2010s, people said inflation will never happen again. We've killed it, right? Look what happened. So I think the great thing about studying history is just how surprised you are at what can and will happen. And I think it's just important to keep an open mind about these things. But yeah, you have to take risk in some form if you want to wish to grow your wealth above the rate of inflation. You just have to. There's no other choice.
Sure. Yeah, Ben, I really enjoyed this. Our guest today is Ben Carlson. His book is Risk and Reward. Go get it. I really enjoyed reading it. Ben, thanks for joining us.
Thanks for having me. Appreciate it.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Cutitta, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.